So I think in terms of this morning, Penny and I are obviously delighted to take you through the results for the last 12 months. In terms of structure for the day, I'll take you through a very brief exec summary and strategy recap. Penny will take you through the numbers, and then I'll just explain probably in a little bit more detail how we've delivered these results. In terms of our executive summary, yeah, it's not very often I use words like outstanding. In fact, the board had to persuade me to put that word in earlier this week because I generally err on the conservative, but I think it's hard not to say it was an outstanding set of results. We were very pleased with how the business performed. And to be honest, as some of you know, Penny's been out on mat leave. When she came back, she was like, trying to find the bad number, and we couldn't find it. And I think that kind of sums up where we are. It really feels like everything was executing well for us. Standout, of course, is the organic revenue growth across the entire company of 11%, which is underpinned by a really strong performance in media, and then the strong growth in EBITDA, nearly doubling to 20.7 million. Obviously, those results are underpinned by our strategy. These things don't happen by accident, and I think that we see that strategy working really well for us at the moment. And our focus is very much on continuing the execution of that strategy, so ongoing investment in our platforms, ongoing investment in our people, and the identification of assets where we believe we can add value. We don't see ourselves as a consolidator in the market, we see it very much as a value adder, so we're looking for where we can identify acquisitions and do something better with them under the future ownership. And on that point, the acquisitions we undertook during the course of this year are all on track and performing in line with our expectations. We're very pleased with that. I thought it was worth, just before Penny goes into the numbers, explaining in a little bit more detail our strategy. Most of you will be familiar with this in the room, although this is now another evolution on of our wheel, but the content's the same. We just keep feeling the need to design it a little bit more every year. I think the key point is that these results are about the execution of this strategy, and the core tenets that underpin what we're trying to achieve right now are building a global platform for specialist media. That global platform is technology enabled, and we believe in media today that's one of our USPs. We think we're one of the few media companies who actually have a unique technology platform. We absolutely believe in the power of brands, and we think scalable, market-leading brands also give us a defensive advantage. We really do believe that creating a place where communities can meet is also powerful, and I'll give you some case studies on that later on today. And then we believe we should be expanding our global reach, and we should do that through organic activity, through acquisitions, but also through partnerships. And again, I'll take you through that in more detail later. And then finally, diversified monetization models. We're very much of the view which is diversification drives a better financial business model and gives us opportunities to take market share. So without any more ado, Penny.
Thank you. So good morning. So I'm going to start with the KPIs, which we've updated to reflect the new shape and size of the organisation. Although the focus remains very much the same, our ambitions are around driving top-line revenue growth, expanding the margin to drive that through to profit, and most importantly, to convert that profit to cash. So we've seen a really strong performance across all of these measures, and it's really a testament to the strong fundamentals of the business that we've been able to drive good organic growth whilst also materially increasing the size of the organisation. So if I move on to show it in a table format, which I find a bit easier to talk through, we'll just run through the numbers. So revenue is up 48%. A lot of that is acquisition, up to 125 million of revenue. But as Zillah touched on, we're most pleased of all about the organic revenue growth of 11%, whilst also changing so significantly the top line through all of the acquisitions. We've expanded the EBITDA margin by 4 percentage points to 17%, and that's really driven the significant EBITDA growth of 88% to 20.7 million, and we'll talk a bit more about how we've got that. And you see the operating leverage flowing through to operating profit, which has doubled year on year to 18.5 million, and a good strong improvement in EPS to 24.3p. There was a tax credit in the previous year, which explains why the growth there isn't as high as it is on a profit level. Seeing the business continue to generate significant cash, so free cash flows of 17.4 million, and that's helping us de-lever quickly. So we raised a bit of additional debt during the year and used all our firepower to buy New Bay and the Haymarket titles, but we've delevered it quickly and we're under 1x leverage at year end at 17.8 million of net debt. So just moving on to revenue, apologies for the very busy slide, but there's been such a sense of change in the organisation. I want to provide a bit more detail about what's going on. So we look at our revenue performance in terms of media mag and also by geography. And the main thing which is really driving the step change in the organisation is the growth in the media revenue. So that's now 52% of revenue, and a pro forma 2018 basis, it's more like 65%. So we moved to 2/3, 1/3 media mag. So in the chart on the right-hand side, you can see the makeup of the media revenue streams and the organic growth percentages. And it's really pleasing to see that all of the revenue streams across the media revenue have seen very strong organic growth percentages. So display is up 22%, and that's around half of the media revenue, around 31 million this year. And that's really where we've invested in the platform, is really paying off with both increases in inventory and the yield, particularly in the programmatic revenue streams. Events up 12% organically, launched one new event in the year, but also big focus on just, we have a mantra of brilliant at the basics around strong execution of the events which are more mature. And then e-commerce continues to go from strength to strength. That's up organically 95% in year, so 18 million this year. Magazines are the other element of our revenue, still a big proportion. Those declined 8% underlying, very much in line with our expectation. In fact, we actually benefited from very strong content publishing revenues in the year. So we would normally expect to see sort of more like double-digit declines, which is very much factored into our plan, so in line with our expectation. And then just at the bottom, you see the split of revenue between UK and US. So you can see that US is now around 1/3 of our revenue, more like 45% on a pro forma basis. And this is really what we've identified as a key growth opportunity for us, explaining the acquisition of Perch. And you can see an organic growth rate of 29% in the US. That's partly why we see it as such a great opportunity for us. So looking at EBITDA, it's the strength of the media revenues which drive the change in the EBITDA margin, driving the growth. So media division gross contribution, the margin is 18 percentage points ahead of the magazine contribution, which really shows how, as we improve the mix of our revenues, that just drops through to the bottom line. So the media gross contributions percentage improved by 3 percentage points as the strong growth in the e-commerce, which is very high margin, flowed through there. The other thing that we try and keep in check is the magazine gross contribution. You would expect the margin to decline over time as those mags decline, but the benefit of the new acquisitions, increasing the strength of the portfolio and continued ongoing portfolio management, means that we've held that margin flat, which we're very pleased with. Admin costs as a percentage of overhead is the other thing that we measure ourselves on. Over time, we expect that to decline. So we've seen that hold flat, despite a number of acquisitions bringing in a significant volume of overheads in the year. And within that number, we were really pleased to pay out our top bonus performance to all staff in the year. We launched last year a kind of new inclusive all-staff profit pool scheme. So had a really strong performance on that. And that drove the EBITDA up to 20.7 million. So just a brief chart showing the growth over the last 4 years, and you can really see sort of the acceleration in growth of the business, both in the margin and the total quantum of EBITDA. So from 3.7 million back in 2015 up to 20.7 this year. So really phenomenal growth. And then just looking at that in terms of cash, this is free cash flow, which is defined as operating cash flows less capex. Again, you can see back in 2015, we didn't generate any cash. We were net cash out, but up to 17.4 million, so continues to go from strength to strength. So just going on to the cash flow in a bit more detail, seen a cash conversion of EBITDA to operating cash flows of 96%. So a cash generative business. Now we've achieved significant scale, and we've continued to focus on working capital. In terms of how we've used that cash, so we've spent around 5 million this year on restructuring. That's largely acquisition related, and then so deal fees, and then the associated restructuring after the acquisition. We spent 4 million on tax. Now 2.7 million of that was a legacy tax debt with HMRC, which we repaid in full in June. So we're now free of that tax debt, which is very, very pleasing. And then CapEx of 2.4. So I'll cover CapEx in a bit more detail. 3 major acquisitions in the year, cost us 117 million. That's Newbay, Perch, and the Haymarket titles, which we funded through share issuance of 102 million and also 4 million additional borrowings. So one of the things that we wanted to highlight was how low the capital intensivity of the business is. So the table shows the CapEx as a percentage of EBITDA over the last 5 years, which showed how much we invested very heavily in building the platform, both front end and back office infrastructure over the last 5 years, which really is providing the operational efficiency that we see today. So we continue to see CapEx of around 2.5 million, and we expect to be able to hold it around that level as we have a very disciplined approach to investments in the platform. So we decide which investments are going to drive the highest return. And we continue to see, therefore, CapEx as a low percentage of EBITDA, really benefiting from the platform approach to drive the operational efficiency. So in summary, a really strong year with EBITDA up 88%, strong organic revenue growth, 3 major acquisitions, which Zillah will touch on in a bit more detail, and the strong cash generation. And then finally, the board were very pleased to be able to announce the recommencement of a dividend at the end of the year, which really shows our confidence in the continued growth in the future. So handing over to Zillah.
Thanks, Penny. Yeah, very pleased to reconfirm the dividend. We really see that as a moment for the business in terms of the journey we've been on. As Penny's just been through, it's a good, strong set of results. However, as I said earlier, these results never happen by accident. And while we started this deck with the strategy, I think what's much more important is how you execute on that strategy. And it's just a consistent mantra at Future around, it's not about the ideas we have, it's about the execution of those ideas. And we're very disciplined in how we go about that. There are 4 pillars that underpin the strategy I took you through earlier, diversifying our audience. And through the course of this year, we've done that in a whole array of ways. Organically, we do that through extending the content channels we cover. So for example, TechRadar, our most mature site, can still grow organically its audience because it introduces new content coverage. So during the course of this year, we went long on audiovisual and televisions, and that's where you then grow more audience. And so that's a route through further growth organically. We also, through our partnerships, have extended into Scandinavia and the GCC in TechRadar, and then clearly through the acquisition of Perch, significantly increased our audiences in the US. So you really see how diversifying the audiences is organic, partnership, and also through acquisition. In terms of the scalable platform, I really can't underestimate how important that is for us in terms of being able to know that we can scale things quickly. And we continue to invest in the tech platform. One thing just of interest this year is we migrated 4 of the acquisition sites onto Vanilla, so What Hi-Fi, Guitar World, and then 2 of the Newbay B2B sites. We also launched 2 new sites during the course of the year. And since the year ended, being September, we've actually migrated 2 more sites through to Vanilla. So it's a very robust platform, highly scalable, and we're doing all of that investment without having to materially change our capital base. And I think that again, goes to the point of the value in the business. The third point then is continued diversification of content monetization. Those of you who know me well will know this is one of the things I'm obsessed about, is having a really good quality range of earnings across our business and that behave in different ways and which really help support the financial engineering of the business. And we really, again, see that working well. Obviously, the biggest change this year was the move into B2B, which at a macro level, if you believe in diversification and you believe in specialist media, is the ultimate next move in diversification, and that's why we did that, and I'll talk more about that later. But we also continue to trial new ideas. One of the things I'm calling out here is we've got some interesting local language trials going on at the moment, just to see how translation works for us. When you think about Tech Radar, and you think about America, and you think about 1/3 of that population not speaking English as their first language, that feels like an interesting trial for us to start considering. And then in terms of ongoing investment, obviously we continue to invest in our technology, but much more importantly, we continue to invest in our people. And I've got a slide on that for later. I mean, a key point in our business is we're all about people. They create our amazing content, and making sure we attract and then retain them is pivotal for us. I thought I would just recap on actually where we are and what brands we operate and what verticals we operate in. The business has gone through a fundamental change in the last 12, 15 months. And sometimes what we take for granted, I realise not everyone is maybe quite on top of. And so I thought just bring it to the fore today and recap where we are. So we have 6 key verticals we operate within the consumer division. In all of those verticals, we strive to have a market-leading position, ideally globally, but at the very least in one of the markets in which we operate. Clearly, the Uber vertical is technology with over 80 million users. Gaming and Ents is our next biggest, at just under 35 million in terms of its reach. But it's worth calling out, Hobbies is now our biggest at 38, and then Music at 25. So through the acquisitions during the course of this year, music has suddenly become a really material vertical for us. And Hobbies, which include Space.com and Live Science, in case you're like me and you weren't sure if it's Live Science or Live Science, it's definitely live, but I have to think about it all the time, is really put power into the Hobbies vertical for us, and so it's really nice to see that extension going through. And then on the B2B side of the business, we've actually added 5 new verticals ranging from media, entertainment and technology through to education, music, and then consumer technology and gaming. And the key point is, we, as I mentioned at the time at the half year, we've knew the Newbie asset for a long time, and one of the things that attracted us to that asset was the fact that it had audiences that we were familiar with. We understood the industries, and so if you're going to go into a slightly new monetization model, how can you do that in a lower risk way? And for us, going into gaming and music and consumer electronics felt like the right move through. And in fact, we actually had an awards last night for Newbie, which I understand Stormzy came along to, so my kids will be really annoyed that they didn't get an invite to that event. By the same token, I thought it was helpful to just recap on the markets in which we operate upon. Again, people sometimes don't quite catch up how quickly we've changed. So we operate across, we have offices in 4 locations, the US, the UK, France and Australia. And on that slide, I've just delineated which members of the ELT are in which locations, and approximate headcounts. You'll understand it changes almost daily, and that's why it's hard to pin it down. I think there's 2 key points I just wanted to draw out in this slide. The first one is we don't operate geographically as an organisation. Our audiences are global, and therefore we have to meet them globally rather than UK versus US. And so whereas 4 years ago we had a president of the US business, we actually don't run that model at all. We run a functional model, so there is someone who looks after technology, and they look after the technology vertical for the entire global audience. And they will have staff in the UK, the US and actually Australia. And we find that makes sure we actually drive the operating leverage out of the business, but also respond best to what the audience wants. And then in terms of the leadership team, 5 of my team are based in the UK, 3 are based in the US, and 1 of them is in Australia. But one of the things, again, I think that's unique about Future is we actually don't have a head office. That's one of the things that we take pride in. And so we very much operate on the model of you go where the business needs you to be at this moment in time. And so for a vast part of last year, I spent a lot of time on the M40 driving up to Bromsgrove as we integrated home interest. Slightly more glamorous, I think. I'm going to New York, but who knows where next year will take me, right? In terms, therefore, then, of the actual underlying business, I thought this was the right first slide to start with, which was about the content we create. At the end of the day, Future is a content business, and this is absolutely who we are. And underpinning our business is the 2 charts here, Tech Radar and PC Gamer, 2 of our older brands, both of whom are growing double-digit CAGRs in terms of audience numbers. And the reason why I wanted to say this is to really get that point across, which is we see further extensions in the product categories we can cover within the core portfolio, in addition to those where we're adding on new brands. The bar chart is representative of which countries we're operating in, and what you'll see is that the pinky colour is the UK, and increasingly the UK for both of those brands is far less important, with the US becoming much more important to us going forward, and so a very pleasing opportunity for us in the business. Now, the talented journalists in the business is what enables that content to grow. People have to, want to read what we write. However, they also have to discover what we write, and in order to discover what we write, we think that's where our platform really gives us advantage. We really do believe we've built something which is best in class, and our technology allows us to scale those audiences around the world. So a core part of the future strategy is the single platform, and that's one of the reasons why we're able to, as Penny said, be so capital efficient from a CapEx perspective. Everything sits on the vanilla platform if we think it's got any scale in it at all. And so, as I said earlier, we migrated 4 of the acquisition brands onto that, being What Hi-Fi, which is what you can see here, Guitar World, Broadcasting Cable, and Tech and Learning, the 2 Newbie brands. So that brings us now to 15 brands on the vanilla platform. To put that into context, we delivered 8.6 billion impressions on the vanilla platform this year compared to 5.5 billion last year. So when we talk about a scalable platform, it's not just we can put more content on it, it's we can robustly serve inventory on it and monetize those audiences, and that gives us high degrees of confidence as we look forward to the next 12 months. Also pleasingly, the second last bullet here is the fact that those sites that migrated saw viewability of their ads improve 27%. So not only are we scalable, not only are we serving lots of impressions, but we're making them easier for them to be seen, which lets us drive a higher yield when we do those migrations. As a kind of sneaky Black Friday, it just happens to be today as well, the busiest day of the year for us is our results day preview. What Hi-Fi, which we migrated onto vanilla in August, I believe is up 200% versus last year today on its trading performance. So that just goes to show about the robustness of the platform, and I'm sure I can tell you that today. So we just look at the brands and loyal communities as core part of our vertical strategy, and I wanted to talk about photography. It's one of our older verticals, and it's a really passionate community. And when we talk about the wheel, sometimes people don't know what I mean. So the shades of grey around this wheel highlight where we're monetizing photography. So there's only one part of this portfolio that we're not monetizing through all of our revenue channels. And the area we don't at the moment is digital licensing, the software as a service proposition. So if we just talk that through, going from left to right, we launched during the course of the year Photographer of the Year on digital camera. If you look at what's happening with that audience, increasingly it's a sharing population. They want to do things more socially. We wanted to engage with that community, and we saw that as a great opportunity for us to engage with those audiences and to build more relationships with them. It's been hugely successful for us. One of our more successful events is the photography show, which is now in its 4th year. However, as you look at what's going on in photography, it's increasingly moving into motion, particularly with the adoption of cameras. And so what we're thinking about is how can we bring cameras into the photography show without upsetting the camera manufacturers. And so the key way into that for us was to add the video show to the event. And so that will run alongside the photography show as part of the proposition that allows us to extend, again, and grow that event organically in terms of our audience. Because of our expertise in photography, Canon, one of the main manufacturers, actually came to us during the course of this year and asked us to work with them on a launch of some of their manufacturing products. And we created over 20 videos for them to use as part of their marketing materials because of our authority. And then those of you will remember we launched Digital Camera World last July as a new online site. And I think we reckon we'd spent not more than £5,000 launching it. It took us 2 weeks to put that site to live. And the chart here shows the impressive audience growth and then happily the revenue growth that follows that as the audience grows. And what we were benefiting from Digital Camera World was 2 things. One, a platform that's scalable, but also the richness and the depth of the magazine content which we can put onto the online platform, which really helps seed the integrity of the site. And you probably can't see it because it's the smallest box in the world. But that little Google box there, I actually put onto this deck yesterday. It's Black Friday rankings, and it really picks up our strategy wonderfully, which is you'll see that Digital Camera World is ranking, if you've got really good eyesight, #1 for best Black Friday camera deals. Ranking number 2 is Tech Radar. And that is our strategy in essence, which is we want to have specialist brands, and then we want to have within those verticals super specialist brands, so that then when people search online, if it's mass market, we meet their needs, and if it's super niche, we meet their needs. And today, for example, there's a whole host of our brands where that's what we're seeing happening, be that cameras or headphones or laptops. So really pleasing to see the strategy working for us. And of course, that strategy then flows through into our organic revenues. So the two charts on here, many of you have been familiar with before, our US business and our e-commerce business. Both of these slides are organic, so before any of the impact of any of the acquisitions, and our US business continued to grow 36% CAGR this year, so 21 million of revenue, nearly a 50% increase from the prior year. And then e-commerce, I'm kind of embarrassed about this one, to be honest, because I keep saying, oh, it can't keep growing at this rate, but we're at 126% CAGR. But I'm positive it can't keep growing at this rate. But it's now more than 17 million of the group's turnover, so really material part of our business now. So I mentioned before about how we drive audience within our mature portfolio, but actually it's worth just taking a step back and looking at this chart to recognise how much bigger future audiences is post the acquisitions we did this year. We really have expanded our global reach significantly. And so not only are the legacy sites double-digit in growth, but what you can see here is through the acquisition of Perch largely, the position of the business in the US has pretty much nearly tripled, which gives us a huge opportunity. And if we go on to the next slide, we can talk about that opportunity in more detail. Many of you will be aware we talk about our revenue per online user. So this is about how well are we monetizing the audiences of the previous slides, are about the volume we're driving in the business. And happily, not only are we growing organically in audience, we're also growing organically through our yields. And what you can see here is our media revenue CAGR in the UK was up 20%, our US is 33%. So the US is definitely growing faster. However, it's not quite at the UK levels. And so when we stop and think about the US being 3x the size of the UK and I think it's 0.6 the size of the UK in terms of its monetization, you can see why we were so excited about the transformational opportunity of the Perch acquisition, and why, if you play this out over the next 2-3 years, we see real further opportunity for growth in the business. So diversified revenues is definitely my personal kind of the thing that I think about all the time, and I thought it was maybe helpful just to kind of bring this to life to you for a little bit in terms of the changes the business has gone through over the last 3 or 4 years. The wheel at the top is obviously the main ways in which we monetize our revenues at Future, and then the pie chart at the bottom tries to bring that to life for you. I think the key takeaway for me, first of all, is there's not one revenue stream which is overly dominant in the business now. So digital ads is our largest at 25%. It will get a bit bigger, I think, in the FY19 numbers as we take in the full 12 months of Perch, but nonetheless, it's still not overly dominant at this stage. But much more important, and I think one of the things I find most pleasing, is we were looking to try and build a business which had 4 or 5 material revenue streams between 10 and 15% of the mix. So we really had a proper, sustainable, different model. And if you look at this now, you've got e-commerce, events, news trade, and subscriptions all sitting at between 10 and 15% of the business. So really happy with the shape of how that's performing for us. And then it is worth calling out that news trade, which is Impulse magazine purchases, is now pretty much the same size as our subscription business, and obviously through the subscription relationship we have a much more engaged relationship with the audiences, and much more control of that supply chain. So that's a key moment for us as well, where these are beginning to be at parity. Historically it was 1/3, 2/3 in the business. So lots of changes in the shape of our business, and we're very excited about how that progresses moving forward. Now, sometimes, occasionally, I get accused by the board of, buying lots of things. I think what's really important is that they hold me to account and we demonstrate our discipline, which is that it's not just about having lots of brands, it's about having the brands that are on strategy and that are profitable. And so one of the processes we do quarterly at Future is we go through a review of the profitability of all the brands in the estate, and also whether or not they're strategically important to us. And if the answer to that is it's not profitable and it's not strategic, then we generally question why it's in the group. During I keep getting messages to buy things on Black Friday from our sites, just in case you're wondering why I'm touching my screen. So you're saving me lots of money. During the last quarter, we undertook that review. We identified around 30 brands that we felt were worthy of further investigation. Through that investigation, we actually decided to dispose or close 10 of those brands. One of the things we really strive to do at Future is where we decide to close a brand, and oftentimes it's a magazine brand, we try and relocate those staff into digital roles or into other roles within the group, and so we've been very successful in that, and Aaron is here today, and he leads that charge for us. And we also, where we think we can find a buyer for it, do that, and we've been successful in doing that for one of our brands so far. I think what's really important about this is that we make sure we as management are spending our time on the things that drive value in the organisation, that we're disciplined about our margin protection, and we don't have anything unduly drag the margin down, and that we also recognise that when we buy businesses, maybe not everything in the business is what we would want, and as a process of diligence, we identify the things that maybe aren't core to us that we might then decide to exit. This is EBITDA enhancing as a piece of activity. And then, as I mentioned earlier, ongoing investments in our people. So you might have got a playbook on your desk. We thought we would just bring them along out of interest. This really is the kind of underpinning of how we induct people into the future culture, and really underpins what we do. So we go through the questions we ask ourselves as an organisation, how we behave, what's our purpose, what's important right now, where are we going, and what's our strategy. And we share this with every single inductee into the company, and we send them away for 2 days to basically take this document apart and understand how we're going to execute upon it. So we take it very seriously, and we think that when you're growing this fast, having alignment within the organisation is one of the core things that's important. And as I said earlier, people really are the core part of our business. So over the course of the year, we've actually grown our colleagues' numbers to in excess of 1,000, which again I find quite hard to say out loud. And that includes the recruitment of nearly 200 people. So not only are we acquiring staff and colleagues from acquisitions, but we're also identifying where we continue to have gaps in our resourcing and hiring into that. So we as I said, we hired nearly 20% of the workforce during the course of this year. We've made a number of investments into our people during the course of the year in addition to the playbook and induction, which includes becoming a living wage employer. We think that not only do we want to attract talent, we also want to retain talent. As Penny mentioned, we have something called a profit pool we introduced a number of years ago, whereby if the business performs well, every single member of staff gets a share in that profit pool, and we were delighted to play that out max this year. We've also got a diverse workforce. I have to be honest, it's not something we set out to do. We just hire the best people, but it means that we've ended up with a third of the board being female and 40% of the executive function is female. And over 40% of my team is also international, so we're not all thinking with the same mindset. And then during the course of this year, we signed the Ascent Promise, which is looking about making workplaces inclusive and sharing our learnings about how to increase inclusion. I mentioned briefly strategic partnerships earlier on. Clearly the business is acquired a number of businesses, and we've obviously underlined our organic growth, but strategic partnerships is also a key part for us. There's many markets where we don't want to operate directly, but we were happy to partner with someone else. So we offer a digital licensing solution to them where they license our software and our brands. That's growing materially during the course of the year. We're very excited about how it's performing. And one of the key standouts is that India is now our third biggest audience for Tech Radar, and we launched during the course of this year into Scandinavia. So we're very pleased with the performance there. This next slide is on acquisitions. Many of you will have seen it before, so I'm not going to dwell on it. The key point for including it was about being able to identify where we are in the journey with each of the acquisitions we've done this year, and recognising that it's through the deployment of this structured framework that we're able to make sure that we add value to our acquisitions and not just consolidate them. So I thought I'd start off with buy and build, which is home interest in terms of the acquisition we did 15 months ago. As far as we're concerned, this business is now BAU and a core part of our operation. But I wanted to just pick out a few key highlights of the last 12 months. The first one is, strategically, we bought home interest because we wanted to expand into a new vertical, which was homes. We saw high value in that. And we also wanted to increase our knowledge of exhibitions and events because we also saw that as a key revenue channel for us. So we're buying talent in two ways with that acquisition. Really, really delighted to say that the events revenue grew 11% year over year. So in a business where we didn't think we were the experts, we were able to deliver double-digit organic growth on the events portfolio. So that was very pleasing. And we actually are launching a new event in January of next year in Farnborough, and that's already exceeded its opening sales targets. So we're very much on track for what we'd like there. However, the key reason we thought we could add value with real homes was the home portfolio was around real homes. We felt the online proposition we could do more with. And so we spent a large part of this year migrating content onto that site and building that up again. It's on the vanilla platform. Today, the audiences grew 7% versus last month. It continues to grow month over month. Revenues are following the same trends, and it's ranking incredibly well for key Black Friday terms. And what's really nice is the team are super excited about it because they're suddenly seeing the content they write reaching audiences that they wouldn't have written before. And so it's wonderful to really see that come to life for us. I thought I'd briefly call out an example on Newbie, which is the B2B business we brought earlier this year. One of the interesting things about Newbie is we actually managed to acquire consumer brands in the music portfolio and also B2B brands. So that's one of the reasons which our consumer B2B portfolio, our consumer portfolio music's grown so much is because of the Newbie acquisition. So through the B2C business, we acquired Guitar World, which we migrated onto Vanilla earlier this year. And we also were able to launch the UK Guitar Show because suddenly we were the #1 player in the market, which was a sellout event for us this year. And we also felt we had the authority to launch World Guitar Day, which is an event we felt as future we could own globally. So we really feel the benefit of being the #1 in the market in that respect. And those of you who followed the Future story for a long time might know we actually originally sold some of those assets in America to Newbie about 8 or 9 years ago, and we definitely got them back for less than we paid for them. So it's beginning to be a trend, I think. On the B2B business, we now are the proud owners of the iconic Music Week brand in the UK, which is the UK's leading B2B title. We very much like that brand. It has a lovely subscription base. We've reactivated the retentions there and seen significant improvements. And then very pleasingly, the Music Week brand itself in terms of awards, we've been able to launch 2 new awards, which included the Music Week Tech Summit and Women in Music, both of which have been hugely successful. And then the iconic awards themselves have been up year over year under our stewardship. So we're really feeling it's coming to life for us in terms of what we're trying to achieve with the commonality of audience, but the different expertises in terms of how we monetize that. And then I couldn't not update you on the Perch acquisition, which is what's been helping me build up my air miles balance at the moment. So we are in week 11 of that acquisition. We're very much in phase 1. We're really pleased with how it's going. We're just delighted about the performance of the business. In fact, I just looked at something online right now where we were #1 was Tech Radar, #2 was T3, #3 was Tom's Hardware, and a little mini fist pump inside on the search rankings. So that's exactly what we're looking to happen. We had actually had 3 offices in New York. We've actually migrated everyone in New York into one location over the last 11 weeks where we've moved 300 people. That is no mean feat. We've also sublet the legacy offices, and one of them is on one-off. We've moved everyone to the Future payroll. We're just about to migrate all of the GL into the Future system, so we are on track in terms of our timings for doing that. We managed to have all the Future staff attend the Future US conference, and that was with 2 weeks' notice. I wasn't very popular with our events planning team when the number coming to the conference went suddenly from 200 to 400. But nonetheless, we got it done. And most pleasingly, the team in Utah who we acquired through Perch sent me a card afterwards, all of them having signed it, saying how delighted they were to have been invited to join their colleagues because it had never happened to them before, which just goes to this point about not underestimating the power of people and collaboration in an organisation. And on that point, one of the other things we've done in the last 11 weeks is meet every single employee we've acquired. So one of the things we think is really important is in the first 3 weeks, we individually interview all of the new members of staff in the Future world, and all of my management team participate in that. And what's really special about that is you begin to understand who are the stars in the organisation because you hear the same names get mentioned all the time. And then you can go up to those stars and say, hey, do you know what? Everyone keeps talking about you. And so suddenly you're able to talk with confidence about the detail in the business and make people feel really special in terms of that you care about them. And we also get really good insight about how to move the integration along so that it's very much worth the investment and time. As I said at the time of the acquisition, there was a couple of brands we didn't think were core to us. We actually sold the Shop Savvy brand earlier this month, and we continue to review the Active Junkie brand, and we'll update in that in due course. And otherwise, everything is on track with what we'd expect. So in summary, another outstanding set of results, continued successful execution of the strategy. The acquisition integrations are on track and have really helped to underpin the accelerated growth in the business. And the trading for the year we have just entered is started well, and we see no reasons to think that the trends of 2018 won't continue into 2019.